Welcome to Mad Money. Welcome to Cramer. I'll be my friends. I'm just trying to help you take a little money. My job is not just to entertain, but to explain and teach you, because man, we got a lot to talk about tonight. Call me, 1-800-743-CBC. Tweet me at Jim Cramer. These days, these days are insane. More record highs, more positives, more money made. And yet another week where the market's hated, just despised. The complaints about it are myriad. Nobody champions stocks except, well, us. And, of course, the legion of buyers who propel these stocks higher. The averages always tell the story. Dow gaining 173 points, S&P advancing 0.49%, NASDAQ climbing 0.72%. It was a really good session, and all I heard were gripes. The rally, once so narrow, is now amazingly broad. The banks, the transports, all sorts of tech, utilities, so many other sectors, small cap, mid cap, whatever, they all just march higher. Now, I know the speculative stocks are a very visible part of the market, and that rankles the pros. But that's been the case with this market ever since the GameStop affair way back in January of 2021. So get over it. Is it more frothy than we'd like? Sure. But it hasn't stopped us from going higher any more than the concentration the Magnificent Seven did not that long ago. Right now, there's a widespread sense that the obsession with the data center represents the top. Yet every time good news or even rumored good news, like Meta perhaps contracting with Oracle for a $20 billion cloud computing deal, well, what happens when it comes out? Fresh new highs. One of these days, we will have a top, a genuine peak. But the things that are supposed to signal a top simply haven't done their job. That's why so many people truly dislike this market, even though it keeps going higher. See, people see things that ordinarily would signal that stocks are ready to peak. But then it doesn't happen, and they don't adjust their expectations. They double down on their negativity. So we watch Oklo up another 29% today. This is one that we're up 100 since I said just go buy it. Because the government favors nuclear for the umpteenth time. We look at the quantum computing stocks, I think you have to buy those too. And we know there's nothing there in the near term. But eventually, there could be, even if those future gains might not go to quantum stocks that are currently trading. But nuclear and quantum aren't nearly as close to earnings, let alone earnings breakouts. But you know what? The buyers don't care. Some say they are thinking long-term. Others say they're gambling. I say there's something else. I think they're winning. And so many wait for the moment when the craziness subsides without realizing that perhaps the only thing that's crazy is the way so many people seem to despise making money in this market. Except right here in Cramerica. And by the way, I'm not apologizing for this, my vocation. If ridiculously speculative stocks keep being winners, I say you should probably try to own one or two of them rather than fighting it the whole way. That's a big theme. My new book comes out in 11 days. I talk about in a full chapter how to speculate wisely, because I don't want you left behind, even though this book is about investing. And with that totally pertinent rant, let's get over to our game plan for next week. By the way, everyone else right now is really tired. Not me, partner. All right, here we go. The president had this big call with President Xi today, right, with China. And all we heard about is that there was this solid discussion about TikTok and some sort of deal reached. I don't think that's the way it comes out with this president. He gives a nice talk, but then saves everything for the weekend. I think over the weekend we'll find out about the other things that were discussed, including what the Chinese will buy from us in exchange for a trade deal. Look, I don't think a long call with the head of China was purely focused on TikTok. I mean, TikTok's like 9 seconds. How about NVIDIA? How about ag? Let's find out what was really said. I think it'll move stocks on Monday. Next up, Tuesday. Tuesday morning, we have AutoZone AZO reports, and I've been recommending this stock for 2 decades because no matter what happens, the company takes whatever cash it has on hand that's spare and uses that money to buy back stock. It's the most aggressive buyback in the New York Stock Exchange. Plus, the average car on the road in this country is getting real old. New ones cost a lot of money. After tariffs, too much money. If you want to repair or maintain your old car yourself, it's easier than ever because the instructions are all on YouTube. Even 5, 10, 17 thumbs, I figure out stuff on YouTube. And the parts, you can buy them at AutoZone. Tuesday night, we hear from one of my absolute favorite companies, which is Micron, symbol MU, or MU. Talk about a sink or swim business. When this commodity chip maker is plummeting, it tears your heart out. Like Indiana Jones, Temple Doom. When it's ramping, it can't be stopped, except that is by the CEO, Sanjay Mehrotra. Sanjay likes to tell you the truth. And he knows that when a stock soars as much as Micron has lately, it can cause real heartache if anything at all slows down. So he calms things down. He's a prudent person in a market that often honors recklessness. And you know what? I love that. when you look at the outrageous trajectories in the nuclear stocks, say, or the quantum stocks, can you imagine any of those execs from those companies ever coming out like Sanjay and questioning whether their stocks should be so high? I certainly can't. I wish more executives would be like this honest man. Either way, Micron's had a big run. I want to wait for a pullback before I recommend it. And I got to tell you, I really did like it. Rewind the tape. In the 80s and 90s, I was all over the thing. Wednesday morning, we get new home sales. Now, we want to see more transactions, but if bonds keep going down in price and up in yield, something that's been right on our faces since the Fed cut short rates Wednesday, then we just aren't going to get the kind of home sales numbers that we'd like. The good news for the housing market, the pool of older homes is growing. The bad news, until we get mortgage rates back down to 5 and change, I don't think there's much hope of boosting home sales to any level that I think is consequential. Now, also Wednesday morning, we hear from one-time market darling, Cintas, the uniform rental company, also provides a bunch of other large services, largely to small, medium-sized businesses, but they've got some large ones too. I think Cintas could bring us an upside surprise. I like it very much at these levels. In the evening, KB Homes reports, and I bet it follows in the footsteps of Lennar, which got hit really hard today, off of some gross margin pressure and the aforementioned stubbornly high mortgage rates. By the way, can I just tell you, Stuart Miller of Lennar, he's fabulous. So if they were struggling, everybody's struggling. These home building stocks simply won't get traction until the Fed says it's not as worried about inflation and it sees a clear path to taking the federal funds rate down to 2 to 2.5%. Until they do, KB Home's just a trade, and I don't want to trade. I talk a lot about that in my book. Trading is for suckers, okay? It's for suckers. Thursday morning, we get results from one of the great stocks of the moment, and nobody ever talks about it except for me. It's Jabil. Now, Jabil it's a manufacturer and does a lot of the technology that we see every day. I think there's tremendous demand for so much of what Jabil makes, so the quarter will once again be terrific. Jabil's consistently brilliant in its making, say, printed electronics devices, a board assembly, among so many others. Now, the big problem here is that people don't really understand all the different things they do, but I really do like them. Let's talk about Thursday evening, though. There we have Costco, and right now Costco is stuck in a kind of a purgatory, very high PE, 53. I find you don't want to buy Costco until the PE goes below 50, but I own it for the Travel Trust, and I'm willing to hold it all I want. It's hard to believe that Costco can vault higher from here, but I think maybe it can. And then finally, we've got this really hard thing to understand, okay? It's the Fed's favorite gauge of inflation. It's called the Personal Consumption Expenditures Price Index. We care about these indices because we want the Fed to get out of the box where inflation goes higher and hiring gets worse. They can't get too aggressive about cutting rates until inflation is truly beaten. But it's hard to get a read on inflation because a lot of these numbers come from tariffs. Ideally, we want to see some data that shows you that tariff-related inflation is one-off in nature. Maybe we'll get that Friday. Bottom line, no matter what, we have to accept that this week brought still one more round of skepticism, derision, head-scratching, and befuddlement as the vast majority of commentators and analysts, at least the ones that I listen to, continue to denigrate a market despite the fact that it's made a huge amount of money for the true believers and people who belong to the great nation of Cramerica. Let's go to Robert in New York. Robert.
Hi, Jim. Long-time listener. Long-time listener. Thank you for everything that you do. I need you to connect the dots for me today, and please explain why the competitive threats to Visa from stablecoins and blockchain is dragging a $400 stock down to $300.
Okay, Robert, you're right in my wheelhouse. And I'm going to tell you, you're right in my wheelhouse. That's what's called the opportunity. These different little entities, and they are very little, have created the opportunity that you need to be able to get a Visa at a good price. Periodically, you get it at a good price. And when you do, pull the trigger. Sam in Massachusetts. Sam.
Jim, with markets at all-time highs, I was interested to see Adobe near 2022 lows. Looks like the stock is suffering
very
from
tough.
competition.
Very tough. Adobe made that quarter, but I think a lot of that was price raising, and I want to see organic growth. If you want to know, like, what, you want to compare that to something, compare it to Workday, which we had on the other day. And I think that they were doing it by doing new deals, not at higher prices, but just a lot of new deals. Organic growth is what we want, not price-driven growth. All right. For some reason, a lot of experts continue to denigrate a market that just makes new high after new high after new high. Get over yourselves. It's worth remembering. It's really good to make money. On Mad Money tonight, FedEx blew away Wall Street's expectations when it reported earnings last night. I'm taking a look at the numbers and giving you my take. Then why did Darden investors have so much beef with the company's latest report? I'm going to dig into the details to see what the heck's going on there. And the Investing Club held our monthly meeting yesterday. I don't know, you can watch the tape. We didn't get a chance to get through all the questions. I'm taking a few more of them as this market charges higher. So stay with Cramer.
Don't miss a second of Mad Money. Follow at Jim Cramer on X. Have a question? Tweet Cramer. Hashtag Mad Mentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Last night, FedEx reported a much better than expected quarter, almost out of nowhere, which is why its stock jumped more than 2% today. Now, this is a stock that struggled since the summer of last year, especially during the original tariff turmoil this spring. While FedEx rebounded from its post-Liberation Day lows in April, it never really got back to pre-tariff levels, pretty much trading sideways over the course of the summer. Going to last night's earnings report, the stock was down nearly 20% for the year. Not great. And it's not like Wall Street was enthusiastic in anticipation of the quarter. If anything, there was a palpable sense of negativity. And whoa, Bank of America downgraded the stock from buy to neutral just last week as part of a broader negative call in the shipping industry. 3 days ago, Evercore did the same thing, taking from outperformed to in line because they were worried about the economy. Even I haven't been particularly positive on FedEx, although I haven't been as negative on this one as I've been on UPS. And I have tremendous respect for CEO Raj Subramanian, who's still in the midst of a long-term turnaround plan. I've been hesitant to recommend the stock lately because this really doesn't seem like a great economy for anyone in the shipping space. Yet when FedEx reported last night, I got to tell you something, they shot the lights out. These guys delivered a very healthy revenue beat, driven by the strength of their core FedEx Express business, which was up more than 4% year over year. The FedEx Freight segment, which, by the way, is being spun off, was basically in line. More important, the company earned $3.83. Wall Street was only looking for $3.61. That's 6% earnings growth. Really very, very good for this company. Even better, FedEx issued its first full-year forecast for the 2026 fiscal year, and those numbers were very good, too. They're talking 4 to 6% revenue growth, and us were expecting 1.1%, although their earnings guidance was pretty much in line with a very wide range. Still, last quarter, they didn't even issue a full-year forecast. They were that hesitant. This time, they really stepped up. I think it's very bullish. Now, in terms of the story of the quarter, a couple things did stand out to me. First, management sounded much more constructive on the overall operating environment than anyone would have expected. They're still clear-eyed about the challenges that are posed by a weak industrial economy and the tariffs. But the word management returned to time and again on last night's conference call was dynamic. It's not a good environment. It's not a bad environment. It's a dynamic environment. What else? Subramanian and his team kept talking about the need for great customer service. Well, I hope so. The CEO talked about the removal of Trump's de minimis tariff exemption, which a lot of people were really worried about going into the quarter. FedEx has been focused on that issue since the spring, because the Trump administration removed the de minimis exemption for goods from China back in May, but the exemption ended for all goods globally at the end of August. Subramanian said that because they'd already handled this with China, they were in a much better position to help shippers in the rest of the world now that the exemption's totally gone. It seems like they've worked some great partnerships about this stuff. At the same time, FedEx is clearly winning market share, and they're not doing it simply by cutting prices. I think they're doing it with better service. FedEx Chief Customer Officer Bree Carreri cited Best Buy, which named FedEx as their primary national parcel carrier after being won over by the company's real-time tracking system for packages. It's worth listening to the call if you like this stock to listen to what they said about Best Buy, because it showed you how good these guys really are. Hey, by the way, while we're talking about FedEx taking market share, it seems pretty clear that they specifically are taking business from UPS. Management was too classy to dunk on UPS. That's what dunk on is by name during the conference call. But I did some private digging, and it's true. Something you can tell simply by reading between the lines of the conference call transcript. The final major piece of the puzzle was the way FedEx managed its costs, with a couple major initiatives discussed yesterday. The first is an effort that FedEx is calling Network 2.0, where they're trying to improve the efficiency of their pickup and delivery system in North America. The company's removing stations from its network and reducing the number of pickup times overall. While the Network 2.0 project sounds like reduced service, it isn't. Management said it's, quote, customer feedback, especially when it comes to the consolidated pickup experience, remains very positive. So they're cutting costs without angering their customer base. That's what we need. At the same time, FedEx is making similar efficiency-driven changes to its European network, long a thorn in the company's side. And they're reporting great progress there as well. Superman said that he was, quote, especially pleased with the team's year-over-year improvements in labor and on-road productivity metrics, end quote, in Europe. And he noted that this was FedEx's best new business quarter in Europe in the last 2 years. Finally, there's what FedEx calls its tricolor strategy, and that's an effort to boost delivery speeds and improve profitability in the company's key air freight business. Now, this is a bit of an oversimplification, but the tricolor initiative is mostly focused on making the company's air freight network more flexible, able to scale up when there's more demand and scale down when there's not. Basically, they're trying to save money by having fewer fixed costs. In this quarter specifically, where international volumes were down due to tariffs, the company is able to reduce its Asia to the U.S. capacity, mostly China, significantly, while adding profitable capacity from Asia to Europe. Put it all together, and you get what we got last night, a much better than expected set of numbers from FedEx that led to a very nice rally in the stock. And I've got to tell you, I thought it should have even been higher. So the question is, can it continue? Honestly, I think it really can. While I want to stay a little cautious given everything that's going on with tariffs and a murky economic backdrop, I think FedEx has been able to do a fantastic job navigating its way through this tricky environment, keeping customers happy and taking a lot of market share while also cutting costs. That makes me feel a lot more confident about this one. It doesn't hurt that the stock's super cheap, trading at less than 13 times the midpoint of their full-year earnings forecast. Remember, the average stock in this market sells at 25 times earnings. And when it all is said and done, I wonder if that forecast ends up looking super conservative in retrospect. FedEx also pays a respectable 2.5% dividend yield, and unlike UPS, which yield is more than 3 times that level, I have no worries that FedEx is going to have to cut it. This dividend is safe. The bottom line, even in a tough environment, FedEx managed to blow away the numbers last night. And looking at how they pulled it off, I got to tell you, I am cautiously optimistic that this one is not done and is going higher, maybe much higher. Mad Money's back there.
Coming up, all-you-can-eat profits? Cramer's digging into the latest earnings from restaurant operator Darden and seeing if now's the time to take a bite. Next.
What the heck just happened to the stock of Darden, the parent of Olive Garden and Longhorn Steakhouse, as well as Ruth Chris Steakhouse, Cheddar's Scratch Kitchen, Yard House, and a few others? Yesterday morning, Darden reported the stock plunged nearly 8% in response, before dropping another 4% again today, suggesting that maybe the consumer is less resilient than we thought, or maybe Darden's changes aren't as appealing as they used to be, or both. It's funny, when you look at the numbers, the results don't seem all that bad. More of a mix of positive and negative. Same-store sales were higher than expected, up 4.7%, led by Olive Garden, the big guy, up 5.9%. Longhorn Steakhouse, really great bargain place, up 5.5%. Those are Darden's 2 largest brands by a pretty wide margin. However, thanks to inflation, their margins came under pressure, and the company ended up reporting a 3-cent earnings miss off a $2 basis. Despite these higher costs, management was still confident enough to slightly raise their full-year forecast for revenue and same-store sales growth, but they did leave their earnings guidance unchanged. So, sure, it's a mixed quarter, but does that justify the stock's decline from 208 to below 185? Come on. Look, I think Wall Street got freaked out by Darden's higher-than-expected costs. Their main culprit here is beef prices, which are it's failing all the restaurant chains, except those, I guess, that are like vegan. Management highlighted a few of the reasons for the current supply constraints, including the screwworm outbreak south of the border that's halted Mexican cattle exports. No one thought that would be that big. And then the sky-high tariffs on Brazilian beef. While companies tend to hedge against these potential price movements, Darden noted that they're only 25% protected from beef prices over the next few months, as they view this current move in prices as unsustainable. So do I, but it doesn't matter. They think the American cow herd will get bigger and prices will come down. That doesn't happen. I fear there will be demand destruction from higher prices. A bad way to take care of the problem, at least if you're running a restaurant. And believe me, I know that because I ran one for a decade. Unfortunately, beef inflation is going to do real damage to the profitability over this period. All the stocks are going down because of this. Now, it doesn't help that Darden's also seeing some inflation in seafood, and that's primarily due to tariffs on shrimp. That's why for the full year, management's going from expecting cost inflation in the 2.5 to 3% range to something closer to 3 to 3.5% range. Now, that's a bad sign, not only for Darden, but for the industry as a whole. The whole industry went down off this Darden call. But the investors that are selling the stocks down on cost issues, I think they might be missing all the things that Darden's doing right to attract customers in this tricky environment. I keep telling you that only value-oriented restaurant chains like value-oriented retailers, that's who's attracting lots of customers in this economy. And Darden's definitely focused on value. They've consistently tried to keep the price increases below the rate of inflation. They're great at that. While that might have exacerbated the company's margin issues this quarter, it's clearly bringing customers into the restaurants. Every one of their casual dining brands saw an increase in visits across all income cohorts. This was led by traffic gains at their largest franchises, Olive Garden and Longhorn Steakhouse, which saw traffic up 2.8% and 3.2% respectively. That alone should have blended the losses. I can't believe they didn't. Of course, as I've mentioned before, good value doesn't just mean lower prices, as customers have shown that they're willing to pay more for higher quality as long as they're still feeling they're getting a relative bargain. Olive Garden occasionally rolls out more expensive items that often prove to be the most popular ones on the menu, like steak and shrimp bucatini, that dish that performed particularly well last quarter. Darden's also been great about giving the consumer price certainty, which is more important than it might sound. Management mentioned that in the current environment, guests are actively seeking price certainty so they know precisely what they're going to pay before they come in. Ruth Chris Steakhouse, for instance, had this $55 promotion for a 3-course meal, and while that's certainly not cheap, it gives people a safer way to splurge on food. Then there's the delivery side of the business. Olive Garden's seeing real success with the rollout of Uber Direct, something they announced exactly a year ago today. Uber Direct lets them do delivery from their own website, and they have the actual delivery handled by Uber drivers. Management says this partnership has helped them appeal to a younger and also more affluent customer base, the kind of people who rarely go to Olive Garden for in-person dining. Interesting. Plus, they're testing a lighter portion section of the menu, and that's something that makes a ton of sense when you got millions of people taking those GLP-1 drugs. That's the weight loss stuff. Very hard to eat big portions when you take the stuff. Of course, Olive Garden hasn't abandoned their old core customers, the people who want to stuff their faces with the never-ending pasta bowl while with unlimited soup or salad and breadsticks for $13.99, which is what I lived off of when my kids were little. Perhaps most importantly, Darden's benefited from the same trends that have helped insulate the broader casual dining spaces from challenges facing the fast casual cohort. Brands like Olive Garden or Chili's or Texas Roadhouse are delivering strong value relative to what customers can find at a typical fast food burger chain. Remember that $10.99 dish at Texas Roadhouse? That's what got me into the stock for the Travel Trust. We had a really good game. We took some off, but now we're down badly. I think that can rally like Darden can. As management emphasized in the last conference call, as customers become more selective with their spending at Darden, they're not just looking for good food at a good price. They also want places where they can, quote, connect and engage with friends and family, end quote. Now, you don't really get that from Burger King, but you certainly can get it from Olive Garden or Longhorn Steakhouse. In the end, I get why so many people sold Darden in response to those higher than expected costs. If food inflation is really out of control, then this is a very tough business to be in. It really is. But the bottom line, I also don't want to overlook what Darden's been doing right. The company's been able to resonate with consumers at a time when they're increasingly discerning about where to spend their money. That's why I don't want to get too hung up on rising costs that, as management sees it, are temporary. And it's why I don't want to give up on Darden's stock, especially now that it's sold all the way down here. 17 times earnings, 3.25% yield. You could certainly do a lot worse than owning shares in Darden, which I believe will come through this bout of inflation just fine. It always has. Maybe that's why, in the end, people like it so much. Carl in Illinois. Carl.
Yeah, Jim, I was wondering, I wanted to get your take on Wendy's and see what you thought about that.
Too risky. I mean, I can tolerate McDonald's here. I actually like McDonald's here at 301. Let me see, where'd it go out? I like McDonald's at 302. And I got to tell you, I'm liking these kind of nice casuals like the Darden Texas Roadhouse. They're down too much. They're down too much. Limited downside here because all the bad news is now in after Darden. Tony in Florida. Tony.
Hey, Jim, I want to give you a big booyah and enjoy your show. And you even have my wife watching your show with me, and she enjoys it.
I love that.
That means a lot.
If I see you like in an airport or down there, I'll tell you something. You tell me that, I'll give you a big hug, give you, both you guys a big hug. It makes me feel great when I hear these things when I'm traveling, when I go places like tomorrow I'm Delaware, Total Wine and more. You want to give me a hug? Go ahead. I already had a cold. I'm pretty immune for the next 48 hours. Go ahead. What's up?
Yeah, and last year we met you in Florida, South Florida, for the bottle, and you and your wife.
Oh yeah, what, the Boca Raton one or the Palm Beach or the Boca Raton?
Palm Beach.
Yeah, that was a great one. My wife was dynamite that one. How about we do now? We go to work. What do we got?
Okay, this stock I bought at 149. It keeps on going down, and even has the Elliott investment in it for $4 billion. Should I stay with Pepsi, buy more, or just get out of it and go
right here at 141? It is bottoming. It's at 7. It's when it gets, it's that 4% yield, Tony. That 4% yield brings people in because it's a safe yield, and I think that management is getting energized to do some good things. You own that stock. Do not trade it. And thank you for the nice comments about. I wish you were coming up to Delaware tomorrow. I could use you. Let's go to John in Arkansas. John.
Booyah, ski daddy.
Whoa, man, fired up Friday. Booyah, what's going on?
Couple of quick questions.
Okay.
I'm calling about McDonald's. Can you give me the skinny on how a dividend is, how they set the price on the dividend?
Oh, sure, what they do. Okay, I'm sorry, go ahead. All right, well, look, they pay a dividend. It's $1.77. They have huge cash flow. They have no problem paying it. It's a fantastic dividend. It's been an amazing company. It does sell at a market multiple of 25 times earnings. I have to tell you, if you own McDonald's here, you bought McDonald's here at 302, I think a year from now you're going to make a lot of money. And Chris Kempczinski is such a good manager. I think McDonald's is a buy. And by the way, I have to admit, as a treat, I still go. Had it last week. Can't beat it. All right, Darden's been doing a lot of things right, and that's what I want to focus on here. You could do a lot worse than investing in this company. Now, much more Mad Money ahead. Ever wonder what really goes on inside our CNBC Investing Club monthly meetings? Whoosh, it's a big secret. With averages at record highs, tonight I'm pulling back the curtain and sharing some market advice with you that I hope you can use. Then Apple's iPhone went on sale today, and I got to tell you, its A1 capabilities are right in front and center of you. I really think that this stock, hey, listen, we've been saying for the last week, buy the stock, and, well, it's just been a real rocket ship. Of course, I'm also going to do rapid fire. Tonight's edition is Lightning Round. Stay with Cramer. We saw yet another record close for all the averages today, and while that means we're making a lot of money right now, you still need to keep a level head about your portfolio, even in this amazing bull market. Yesterday, we had our Investing Club monthly meeting where Jeff Marks and I get together to walk club members through our own decision-making process for the portfolio. We disclose our current holdings, and then we take questions from our club members. My favorite part of these meetings is taking your questions, and since we never have time to take all of them, well, tonight I'm going to give you kind of an inside look at what happens in these monthly meetings, while also hopefully doling out some much-needed market advice. I think so. First up is a question from Kenneth, who asks, I don't see any particular news about Waste Management, but the stock has been going down fairly steadily from its recent high. Do you know of any reason why? And is it getting to a point where I should maybe buy more, or is it a sell? Okay, so look, this is really important. This is a company that really does, I mean, the main factor of what controls WM is, believe it or not, lots of housing construction. And a lot of people feel that that's kind of on hold. I'm not going to disagree with that. But I will say this. I think the stock's a buy. I don't think the numbers are coming down anymore from here. I've been waiting for the stock. I looked at it when the trust was thinking about buying it right here. And then I was worried about exactly what I just mentioned. At these prices, I'm not worried. I think it's just plain out and out a buy. I would buy it on Monday morning. All right, next up is Stephen in Rhode Island, who asks, Santander Bank has been doing quite well. I was wondering if it makes sense to continue to add to my position even at this level. Okay, Banco Santander is the largest bank in Europe. This is run by Anna Boutin. It's a sensational bank. When it got to 10, Well, that's Seabridge Gold, which is not exactly Santander. But I will say this: at $10, you should wait till it goes back to $9. I'm not kidding. I've watched the stock climb and climb and climb. It had a little bit of a spike. I don't like that. Under 9 would be a terrific level. Still got a good yield. And there you go. Try to get it here. It could happen, all right? It's a fantastic bank, but it does sometimes trade a little strange. It is my favorite bank in Europe. Now let's go to Victor in Florida, who asks, when is the right time to sell the banks? I bought JP Morgan, Goldman Sachs, Morgan Stanley, and Wells Fargo a few years back on your advice, and have done very well. I thought increasing rates was helping the banks. Now that rates are coming down, should we expect financials to drop and when? Okay, so what matters is actually the long rate versus the short rate. If the long rate's higher and the short rate's down, well, these banks borrow short and they lend long, and that's a sensational time for them. I think all of these banks are good. Now, we own Wells Fargo for the trust and Goldman for the trust, and they've just been fantastic. Do you need all of them? No. But you know what? It is a little bit of pick 'em, because these four are all great. Now, I know you probably that sounds very glib, but oddly enough, Wells Fargo, which is only up 13, I think is the best position to go higher. But any of these are fine. I would like you to think that you only have one. Let's say don't put more than a fifth of your portfolio into banks, and you can either reduce all of those or sell some. But you've got a great investment going. I like them all. I wouldn't sell personally. Next up, Dave in Indiana. I am trying to get my teenage children excited about following stocks. Do you have a few stocks in mind that are brand names that teenagers would recognize that also happen to be good companies for young investors in a reasonable entry point? Yes, I do, okay? I would suggest DoorDash, I would suggest Robinhood, and I would suggest Reddit. Those three, I think everybody would understand. Don't have them buy them all at once. Let's say they want to buy 10 shares. Buy them slowly. Buy 2 at a time. It's okay. The old days, the commission for 2 was the same as 100. These days, no commission. Just go buy on the way down. Use $3 to $5 increments because those stocks are all high dollar stocks, and then they'll follow them because they know them. All right, next up, Alan in California asks, Dear Jim and Jeff, that's Jeff Marks, my partner, thanks for all of your insights, teachings, and recommendations. They've been life-changing. Well, thank you. What are your thoughts for the cruise industry with falling interest rates but higher unemployment? Carnival Corp, Royal Caribbean are up huge, but what the outlook and should we climb aboard? I saw today we had someone who cut the price target in Royal Caribbean for the same reason, but they also raised the price target in Viking. So, I mean, I don't know what they're really getting at. I'm not changing my view. These are all terrific, every single one of them. And Royal's my fave, and I am not going to back away from it because I don't think it's much related to employment as it is related to value. Cruises are great value. They're far less expensive than staying at a hotel, and they're a lot of fun. I've taken 2 of them in the last year. I got to tell you, I think they're fabulous. Next, Lori in New Jersey wants to know, does it make sense to reinvest dividends for partial shares in this environment? Thank you, and go Birds. Go Eagles. Yes, it always makes sense. Just constantly reinvest. I don't hear anything. Don't do anything but reinvest. There, I've made that point. Now let's go to Byron, who asks, this spring, at the tariff downturn, I bought Robinhood, SoFi, and Reddit. Man, you are smart. Since then, they've all doubled or more. In late August or early September, I got a little nervous and sold half or more, 2/3 of SoFi. They're continuing to go higher, and I feel like I panicked too early. Can I buy it back in and violate the basis? No, I don't want you to do that. I want you to wait till they come down. I don't want you to turn a great investment into a bad trade. Every one of those is terrific. Don't feel bad about SoFi. That was an incredible. Actually, look, let's feel bad about the losers, not the winners. That SoFi was incredible. We recommended SoFi at 4. I'm looking at my executive producer, Regina Gilligan. She remembers when we did it. It was like one of these moments. It was a cold shot. I feel terrific about it. But you just had a great investment, and you booked a big profit. Nobody ever got hurt booking a profit. Our last question comes from Kyle in Michigan, who asks, with rate cuts looming, is now the time to offset an aggressive portfolio with Realty Income or Simon Property Group? Thanks. P.S. Can club members get an autographed copy of the new book? The new book! Oh, my God, the new book! Here we go! Yes, How to Make Money Anymore. Look at this, with a picture of me when I was like a little bit younger. And I don't know about the rules for the buy, but look, just get it. All right, there you go. Right there. Amazon. Boom, boom, boom. Rate cuts looming. Rate cuts are Simon Property and Royal. I don't really care what. These are both fabulous companies, and this you get a monthly dividend. This thing has just been a rocket ship from 130 all the way to 188. But I really, really like. Oh, there you go. I really like both of them, and I think that you'd be in great shape. And thank you for mentioning the book, which goes on sale September 30th. Look at this. I mean, I know I was a little younger, but I'm more spry now. That's what my trainer tells me. All right, thanks to all our club members, and I really do love the club members. And, well, you know what? Mad Money's back after the break.
Coming up, Cramer takes your calls, and the sky's the limit. It's a fast-fire lightning round. Next.
It's time for the lightning round. And then the lightning round is over. Are you ready, Ski Dad? Time for the lightning round. We're starting Gary in Ohio. Gary!
Jim Cramer.
Yo.
How are you? Thank you for taking my call and your wonderful
My pleasure.
staff.
Oh, thank you.
You are the grand poobah of Wall Street.
Holy cow.
I'm just going to make this quick. I want to know if I should continue to hold or pull my hair out some more with CMS Energy.
Consumers Energy. I like Consumers Energy. I think it's fine. It's good. Mark Electric Power, I look a little more warming up again to separate. You know, after that bad quarter, I'm coming back. Let's go to Danny in New York. Danny.
Booyah, Jim. This is Danny from Brooklyn, New York. Long-time listener, first-time caller.
I'm from Brooklyn,
Happy
New York.
Friday.
I love it. Happy Friday to you.
So I want to talk to you about Ramaco Resources.
Oh, man, you want to talk about coal, huh? Okay, look, the president likes coal. He likes nuclear. The president he doesn't like wind, and he doesn't like solar. Isn't that funny? All right, here's the deal. I think that this stock has gone up so much. Please wait for a little bit of a pullback because the president may want coal, but the utilities don't. And that's, in the end, who burns the coal. Let's go to Scott in Florida. Scott.
Jimmy Chill. Love the show. Been watching you for over a decade now. Saw you out in Jackson Hole. Beautiful place. Incredible. Anyways, I'm calling about Accenture. And curious
all right, now I got to tell you, Accenture's come down enough. It hit a 52-week low. I mean, how bad could it really be? It hit a 52-week low today. I don't think it's that bad. The only thing I would change is that when you put it in spell check, it always goes to CAN instead of ACN, but that's not really their fault. I think that at 18 times earnings, I'm willing to pull the trigger, Accenture, and that's the first time I've said that because I have really disliked the stock. Now we're going to go to Hector in Maryland. Hector.
A big booyah from the great state of Maryland. How you doing, Jim?
It's a fabulous state. It's really good there. And I'm doing well, thank you. What's going on?
Yes, I own stock and stock symbol OKTA, and I was wondering, should I hold?
I like Okta because I like identity management, but you know what? Palo Alto's got great identity management now that they're buying CyberArk. So I got to send you over to PANW. All right, let's go to Philip in New York. Philip.
Booyah, Jim. How are you?
I'm doing well. How about you?
Great. Listen, I've been watching your show for 14 years since I was a kid, and just wanted to thank you for all the work you've done over the years.
Thank you, man. That was right about then. You were there when we started with FANG. Yeah, right here, FANG. All right, go ahead.
Listen, my question, with this week's rate cut and more likely coming, do you think falling mortgage rates finally send us to the moon with rocket companies?
Man, everyone's kind of, here's the problem, sir. Everyone's kind of done that trade. I would much rather see it be in Wells, which is resting here at 80. Divide it by 4 and call it a $20 stock. I just think what matters is that Wells is the one at this point that is spring-loaded. This one has already gone off. And that, ladies and gentlemen, of the Lightning Round!
The Lightning Round is sponsored by Charles Schwab. Coming up, which companies are best at using AI to boost their profits? Cramer is giving you his take on the current state of the AI revolution. Next.
We're starting to see some tangible evidence that artificial intelligence can genuinely raise numbers for companies, and it's a welcome change. For the longest time, I've heard endless gripes about AI, specifically the fact that NVIDIA, which makes the chips AI runs on, has been the only company making real money from the theme. It's a great way for NVIDIA to make a fortune, but we haven't seen much evidence of anyone else benefiting from it. Now, I think that there's some truth to that. At least when it comes to the giant hyperscalers, the Metas, OpenAIs, Alphabets, that are spending tens of billions of dollars to take the mantle as the top chat bot. if you can become the top dog, you might become to the chatbots what Google is to search, means everything else is Bing, which would also mean all the AI spending was a terrible waste of money for the losers. Basically, we have an AI arms race. And in arms race, you only really want to own the arms dealers. But we finally have some companies that I've been able to use, that I've really been able to, kick the tires and say, you know what? They are making money with AI. They are creating, let's say, in the case of FedEx, we saw them create patterns of goods and where they're shipped that can be gamed correctly. And that saved FedEx a lot of money that it told you about last time when it reported. They're putting up superior numbers, especially on cost, because of the pattern recognition. AI is working for them, and it's making their workplaces a lot more efficient. That's how you can make a lot more money without a lot more volume. When I talked to Tim Cook this morning, the CEO of Apple, reminded me that the iPhone 17 is full of AI, including Center Stage. Oh, man, this great new feature is for selfies, which ensures that everyone in the picture gets in the picture. It isn't cut off. My eldest daughter, she's got real long arms. We call her Cece Long Arms because she's always the designated selfie taker. As fewer people are cut out of her selfies than me, where it's like you got mostly half people. Being able to do that automatically with software and not get anybody cut out, wow. That's worth a serious upgrade. Tim tells me it's generating a lot of interest. He and I both love taking selfies. This new camera is pure dynamite. Next month, when Salesforce throws its Dreamforce conference, the company is going to show you real artificial intelligence use cases, many of which have augmented sales and earnings for their clients. Boy, I can't wait to see that. Mark Benioff's Agentic's portfolio, basically bots that interact with humans, is growing by leaps and bounds. The analysts have adopted a rap that Salesforce's older businesses are no longer growing the way they used to. Now, I don't see that happening. I do want to see some accelerated growth from this particular Agentic's portfolio, though. But then I've been thinking, and I say this is Jeff Marks, my partner for the Travel Trust. I said, after the stock's severe decline, Salesforce is down 26% this year. Maybe we don't even need to see turbocharged growth from Agentics. We may be near the levels where the growth of the Agentics business can soon make up for whatever they've lost from traditional cloud software, if they've really lost anything. Hey, speaking of Agentics, there's no doubt that CrowdStrike's cybersecurity business is crushing it because the AI agents can't be trusted not to be hacked. The North Koreans are going hard against the AI agents. They even have a game plan that includes applying for and getting jobs at companies that hire remotely. One was hired. That's right. One of these bots from North Korea was hired and performed at such a high level that his superior wanted to keep him. But alas, he was a spy. I keep hearing that AI is doing a great job in the banking and brokerage business. I don't know. We just can't see it yet in the efficiency numbers that they publish quarterly. Same goes for the companies that serve them, especially the accountants and lawyers. They're private entities, very hard to gauge. I know that there are AI programs out there that digitize and automate what people do at banks, but banks seem loath to say which jobs are being wiped out. That said, I think these professions are reluctant to use the services of AI too greatly because of the mistake factor. Even after all we talked about it for the last couple of years, there are just too many mistakes still being made by the chatbots, and you really can't afford to screw up like that if you're working as an accountant or a lawyer. To rely on them now before they have reasoning powers, that seems ill-advised. But not for long, because the next generation arms dealer, NVIDIA, has products that have the capability that I think will exceed the capability of a thinking person. It's finally going to happen. You're going to trust the machine over the human. As long as there's no reasoning, the mistakes mean that it's too hard to rely on these bots for anything serious. But once that next generation chips comes out next year, it's all going to change. It's coming. So be patient, because it's almost upon us. I like to say there's always more somewhere I promise to find just for you right here on Mad Money. I'm Jim Cramer. See you Monday.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.